The three-currency war, dollar versus yuan versus euro. Only one survives by 2030, and it's not dollar. There's a war happening right now that will determine who controls the global economy for the next century. Not a war with missiles or tanks. A war fought with central banks, trade agreements, and currency swaps. Three empires, three currencies, one outcome. The dollar, the yuan, and the euro are locked in a battle that only one can win. And the signs say it won't be the dollar. This isn't speculation. This is game theory playing out in real time across every continent. In 2020, the dollar accounted for 61% of global reserves. In 2025, it's 58%. That's a 3% drop in 5 years, representing trillions shifted away from American currency. The yuan went from 1.2% to 3.5%. The euro held steady at 20%. These aren't just numbers, they're battle lines. Every percentage point lost by the dollar is territory gained by its rivals, and the momentum is accelerating. By 2030, one of these currencies will dominate global trade. One will be the reserve currency that matters. The other two will be regional currencies fighting for survival. Let me show you exactly how this war is being fought, who's winning, and why the outcome is almost certainly not what American policymakers want you to believe. Before we understand the war, you need to understand what's at stake. Being the global reserve currency isn't just prestige, it's power. Real, measurable power. When you're the reserve currency, you can print money and buy real goods from other countries. You can run trade deficits indefinitely because other nations need your currency for reserves. You can sanction enemies by cutting off their access to your currency system. You can borrow at lower interest rates because global demand for your bonds is structural. This is worth trillions, literally trillions in economic advantage. The US has had this advantage since 1944. That's 81 years of exorbitant privilege. But privilege isn't permanent. It's earned through economic strength, maintained through trust, and lost through abuse. And right now, in 2025, that trust is fracturing. Here's what the war looks like on the ground. The dollar's weapon is legacy infrastructure. SWIFT, the system that handles most international bank transfers, is dollar-denominated. Most global debt is issued in dollars. Most commodities are priced in dollars. The US has spent 80 years building this infrastructure, and it's incredibly difficult to replace. This is the dollar's fortress, deep, entrenched, defended by institutional inertia. But fortresses can be bypassed, and that's exactly what's happening. The yuan's weapon is trade volume. China is the world's largest exporter and second largest importer. In 2024, China's total trade exceeded $6 trillion. That's more than US trade, more than Eurozone trade. And China is systematically making that trade happen in yuan instead of dollars. In 2025, over 30% of China's trade is settled in yuan. That's up from 12% in 2020. Russia buys Chinese goods in yuan. Brazil sells soybeans in yuan. Saudi Arabia accepts yuan for oil. This isn't theory, this is happening. Every transaction that shifts from dollars to yuan is a brick removed from the dollar's fortress. The euro's weapon is institutional stability. The European Central Bank isn't printing money at the pace the Federal Reserve is. The Eurozone runs a trade surplus. Germany's manufacturing base is still formidable. And the euro has something neither the dollar nor yuan can claim right now. It's not weaponized. The US uses dollar dominance to sanction enemies, freeze assets, cut nations off from SWIFT. This makes the dollar a tool of American foreign policy, which means holding dollars carries political risk. If Washington doesn't like your government, your dollar reserves could be frozen. Russia learned this in 2022 when $300 billion in dollar reserves were frozen after the Ukraine invasion. That sent a signal to every non-Western nation. Dollars aren't safe if you're not aligned with America. The euro doesn't carry that risk. Brussels doesn't freeze reserves. The euro is politically neutral. For nations that want reserve currency stability without political exposure, the euro is appealing. So here's the battlefield. The dollar has infrastructure, the yuan has volume, the euro has neutrality, and each is leveraging its advantage to gain ground. Now let me show you the three fronts where this war is being fought, and on each front, the dollar is losing ground. Front 1, oil. The petrodollar system has been the foundation of dollar dominance since 1974. Every barrel of oil sold globally was priced in dollars. This created structural demand for dollars. Every country needed dollars to buy energy. This wasn't an accident. In 1974, the US made a deal with Saudi Arabia. America would provide military protection and weapons. Saudi Arabia would price oil in dollars and recycle petrodollars into US Treasury bonds. This deal held for 50 years. But in 2023, it started cracking. Saudi Arabia began accepting yuan for oil sales to China. This was a seismic shift. For the first time since 1974, oil was being sold in a currency other than dollars at scale. Not just small experimental trades, billions of dollars worth. In 2024, Russia, under sanctions, started selling oil to India in rupees and to China in yuan. Iran sells oil in yuan and euros to avoid dollar-based sanctions. Venezuela, under sanctions, accepts yuan. By 2025, roughly 15% of global oil trade is settled in non-dollar currencies. That's up from less than 2% in 2020. The petrodollar isn't dead, but it's wounded, and every year, more oil flows outside the dollar system. This is front one, and the dollar is retreating. Front two, central bank reserves. This is the most important battlefield because central bank reserves are the foundation of reserve currency status. In 2000, central banks held 72% of their reserves in dollars. In 2025, it's 58%. That's a 14 percentage point decline. In absolute terms, that's roughly $2 trillion shifted out of dollar assets. Where did it go? The euro absorbed about 1%. Gold absorbed significant amounts. Central banks bought over 1,000 tons of gold annually, from 2022 to 2025, the highest pace since the 1970s. And the yuan absorbed the rest. China's Belt and Road partner nations are shifting reserves to yuan because their trade is increasingly with China. If you're Pakistan and 30% of your trade is with China, why hold dollars? You need yuan. The same logic applies to Indonesia, Malaysia, Thailand, and dozens of African nations. This shift is strategic, not emotional. Nations are diversifying because the dollar's dominance creates risk. If the dollar loses value, their reserves lose value. If the US weaponizes the dollar, their reserves are vulnerable. So they hedge 20% dollars, 20% euros, 10% yuan, 10% gold, and 40% in other assets. This is the new model, and it's becoming standard practice for emerging markets. The US can't stop this. You can't force sovereign nations to hold your currency. You can only make your currency attractive enough that they want to hold it. And right now, endless deficits, money printing, and political weaponization are making the dollar less attractive every year. This is front two, and the dollar is losing ground steadily. Front three, trade agreements and currency swaps. This is where the yuan is making the most aggressive moves. China has established currency swap agreements with over 40 central banks. These agreements allow countries to trade directly in yuan without converting to dollars first. In 2010, China had swap agreements worth 100 billion yuan. In 2025, it's over 4 trillion yuan. That's a 40x increase in 15 years. Brazil and China finalized a deal in 2023 to trade in their own currencies. No dollars involved. India and UAE are settling oil trade in rupees and dirhams. ASEAN nations are negotiating a framework to settle intra-regional trade in local currencies. The goal is explicit. Reduce dependence on the dollar. Every bilateral trade agreement that bypasses dollars is another crack in the foundation, and these cracks are multiplying. The European Union is also pushing for euro-denominated trade. The EU has been trying to create a euro-based payment system independent of SWIFT since 2018. It's called Instex. It hasn't gained massive traction yet, but the infrastructure exists. If dollar weaponization accelerates, European companies could shift to Instex for trade with non-aligned nations. This would bypass dollar clearing entirely. These aren't hypothetical plans. These are operational systems being built and tested right now. And every system that bypasses the dollar weakens its network effects. This is front three, and the dollar is being outflanked. Now here's where it gets critical. Because wars aren't won by defense, they're won by offense. And right now only one currency is playing offense. The dollar is playing defense. The Federal Reserve is trying to maintain confidence while managing inflation, debt, and deficits. US policymakers talk about dollar strength, but they're not taking aggressive action to secure its dominance. There's no plan to eliminate trade deficits, no plan to stop money printing, no plan to reduce the weaponization that's driving nations away. The dollar strategy is hope. Hope that legacy infrastructure is enough. Hope that no alternative can scale fast enough. Hope that the world is too dependent on dollars to leave. Hope isn't strategy. The euro is playing defense too. The European Central Bank is trying to maintain stability, but Europe has structural problems. Aging population, energy dependence, political fragmentation. Germany and France can't agree on fiscal policy. Southern Europe is drowning in debt. The euro is stable, but it's not expanding its reach. It's holding ground, not taking territory. The yuan is playing offense, and this is why China is winning the war. China isn't waiting for market forces to adopt the yuan. They're engineering adoption. Belt and Road Infrastructure loans are denominated in yuan. Chinese companies operating in Africa and Latin America pay local workers in yuan. China is building yuan clearing centers in London, Frankfurt, Singapore, and Dubai. They're offering incentives for nations to hold yuan reserves. Discounted trade terms, lower interest loans, access to Chinese markets. China is buying compliance, and it's working. In 2020, yuan-denominated trade was concentrated in Asia. In 2025, it spans Africa, Latin America, and parts of Europe. The yuan's footprint is expanding faster than any currency in modern history, not because it's the best currency, because China is making it the most convenient currency for nations that trade with China. And since China is the world's largest trading nation, that's a lot of countries. This is offense. This is how you win a currency war. You don't wait for people to choose your currency. You create systems where your currency is the path of least resistance. Now let me show you the 3 scenarios for how this war ends, because there are only 3 possible outcomes, and 2 of them are catastrophic for the dollar. Scenario 1. The dollar retains dominance. This is what most Americans assume will happen. The dollar has been the reserve currency for 81 years. It survived the Vietnam War, the stagflation of the 1970s, the 2008 financial crisis, COVID. It's resilient, and the infrastructure supporting it is vast. For the dollar to retain dominance, several things must happen. The US must reduce its trade deficit significantly. Right now, the US imports $800 billion more than it exports annually. This floods the world with dollars, which dilutes their value. To stop the bleeding, the US needs to either export more or import less. Both are politically painful. The US must stop currency debasement. The Federal Reserve has printed over $10 trillion since 2008. This has eroded confidence. To restore it, the Fed needs to maintain a strong dollar policy, even if it means higher interest rates and slower growth. Again, politically painful. The US must stop weaponizing the dollar. Sanctions, asset freezes, and swift exclusions have shown the world that holding dollars carries political risk. To rebuild trust, the US would need to commit to neutrality, allowing even adversarial nations to use dollars without fear. This is politically impossible in the current climate. So Scenario 1 requires the US to make choices that go against short-term political interests, reduce consumption, accept slower growth, and give up geopolitical leverage. No administration, Democrat or Republican, will voluntarily do this, which means Scenario 1 is unlikely, not impossible, but improbable. Scenario 2, the yuan becomes the dominant reserve currency. This is what China wants, and it's not as far-fetched as it sounds. For the yuan to win, China needs to do 3 things. First, make the yuan fully convertible. Right now, China has capital controls. You can't freely move money in and out of China. This limits the yuan's appeal as a reserve currency. If China opens its capital account, allows free conversion, and lets the yuan float, it becomes a viable alternative to the dollar. Second, build trust. The yuan is controlled by the Chinese Communist Party. There's no independent central bank. Policy making is opaque. For the yuan to be a trusted reserve currency, China would need to create institutional credibility, independent audits, transparent monetary policy, rule of law for foreign investors. Third, maintain trade dominance. As long as China is the largest trading nation, demand for yuan will grow. If China's economy continues growing faster than the US and Europe, the structural shift toward yuan will accelerate. Here's the problem. China is doing the third part. Trade dominance is increasing. But the first two parts, convertibility and trust, aren't happening. China won't give up capital controls because it would mean losing control over its financial system. And the Communist Party won't cede monetary policy to an independent institution. So the yuan is expanding its reach, but it can't fully replace the dollar without structural reforms China isn't willing to make. This makes scenario 2 possible, but incomplete. The yuan will grow in importance. It might reach 15% or 20% of global reserves by 2030. But it won't replace the dollar entirely, because China won't make the yuan fully open. Scenario 3, the multipolar currency world. This is the most likely outcome, and it's the most chaotic. In this scenario, no single currency dominates. Instead, the world fragments into currency blocks. The dollar dominates the Americas, the yuan dominates Asia and parts of Africa. The euro dominates Europe and parts of the Middle East. Trade between blocks is settled in gold, SDRs, or bilateral agreements. This isn't clean. It's messy, inefficient, and volatile. Without a single reserve currency, transaction costs rise, exchange rate risk increases, global trade slows because every transaction requires currency conversion. But this is where the momentum is heading. The dollar's share of reserves is declining. The yuan is rising but capped by structural limits. The euro is stable but not expanding. No single currency is positioned to replace the dollar completely. So the world defaults to fragmentation. Multiple regional currencies, each dominant in their sphere, none dominant globally. This is scenario 3. And every indicator suggests this is where we're heading by 2030. Now here's why this matters for you. Because currency wars don't just affect governments. They affect your savings, your purchasing power, your financial future. If the dollar loses reserve status, even partially, several things happen. First, the US can no longer run massive trade deficits without consequences. Right now the world needs dollars, so they accept them in exchange for goods. If that demand drops, the US has to balance trade. That means importing less or exporting more. Either way, American consumers face higher prices and reduced access to cheap foreign goods. Second, US borrowing costs rise. The US government borrows at low interest rates because global demand for treasury bonds is structural. If that demand drops, interest rates rise. Higher rates mean higher government debt payments, which means either higher taxes or cuts to spending. Both are painful. Third, inflation accelerates. If the dollar's value declines internationally, imports become more expensive. Oil, electronics, clothing, everything that's imported costs more. That's inflation. Your paycheck buys less. Your savings lose value. Fourth, asset prices become volatile. Real estate, stocks, bonds, everything priced in dollars becomes unstable if the dollar's value is uncertain. Wealth held in dollar-denominated assets faces risk. This isn't theory. This is what happened to Britain after the pound lost reserve status. The pound devalued repeatedly from 1949 to 1967. British citizens saw their savings lose half their value. Imported goods became unaffordable. The standard of living declined for an entire generation. The same thing will happen to Americans if the dollar loses dominance, not overnight, but over a decade, slowly then suddenly. So what do? First, understand that holding only dollars is a risk. Diversification isn't optional anymore, it's survival. You need exposure to assets that hold value across currencies. Real estate in stable markets, productive businesses, commodities like gold and silver. These aren't denominated in any single currency. They hold value regardless of which currency dominates. Second, watch the trade data. If the US trade deficit continues growing, that's a sign the dollar's structural problems are worsening. If the yuan's share of trade settlement continues rising, that's confirmation the currency war is accelerating. Third, pay attention to central bank actions. When central banks sell US treasuries and buy gold, that's a signal they're losing confidence in the dollar. When nations announce new currency swap agreements, that's infrastructure being built to bypass the dollar. These are early warning indicators. Fourth, be prepared for volatility. The transition from a single reserve currency to a multipolar system won't be smooth. There will be currency crises, sudden devaluations, and financial instability. Having liquidity, having diversified assets, and having flexibility will be critical. Now let me show you why 2030 is the deadline. Because this isn't a slow drift. It's a tipping point that's approaching fast. The BRICS nations are expanding. In 2025, BRICS includes Brazil, Russia, India, China, South Africa, Egypt, UAE, Iran, and Ethiopia. That's 45% of the global population and 35% of global GDP. They're building alternative financial infrastructure. The new development bank, BRICS payment systems, trade agreements that bypass Western institutions. By 2030, this infrastructure will be mature enough to handle significant trade volume outside the dollar system. China's Belt and Road Initiative will be complete. Over 150 nations will have infrastructure projects financed by China, denominated in yuan. These nations will have structural reasons to hold yuan and trade in yuan. The debts are in yuan. The investments are in yuan. The trade flows are in yuan. The US debt crisis will be undeniable. By 2030, US federal debt will exceed $40 trillion. Interest payments alone will consume over $1 trillion annually, more than defense spending. This will force a choice: default, inflate, or cut spending dramatically. All three options undermine dollar confidence. Europe's energy transition will be complete. By 2030, Europe will be less dependent on external energy sources. Solar, wind, and nuclear will provide most of their power. This reduces their need for dollars to buy oil and gas. It makes the euro more self-sufficient and attractive as a reserve currency. These timelines converge around 2030. That's not arbitrary. That's when the infrastructure, debt dynamics, and geopolitical shifts reach critical mass. The currency war won't be decided by policy papers or G20 meetings. It will be decided by billions of individual transactions, every company choosing which currency to invoice in, every central bank choosing which reserves to hold, every nation choosing which trade agreements to sign. These decisions are happening right now, and they're moving away from the dollar. Not because the dollar is bad, because the alternatives are becoming viable. And once alternatives exist, network effects reverse. The dollar was dominant because everyone used it, so everyone had to use it. But if enough people stop using it, the rest follow. This is how reserve currencies die. Not through dramatic collapse, but through gradual abandonment. Until the tipping point. And then it's fast. Britain's pound lost half its reserve status in 10 years from 1950 to 1960. It seemed stable, then suddenly it wasn't. The dollar is following the same pattern. Slow decline in reserve share, gradual loss of confidence and search for alternatives. We're in the early stages, but the momentum is building. By 2030, we'll know the outcome. Either the dollar will have stabilized its position through radical policy changes, or the yuan will have expanded to 20% of reserves and challenged dollar dominance directly, or the world will have fractured into currency blocks with no single dominant currency. The third option is most likely, and it's the option that destroys the most wealth. Because transitions are never smooth, they're chaotic, fortunes are lost, savings evaporate, and the people who see it coming position themselves to survive. The people who don't get wiped out. This is the three-currency war. Dollar versus yuan versus euro. Only one survives as the dominant reserve currency by 2030, and the data says it's not the dollar. It's not the yuan either, because China won't make the necessary reforms. It's not the euro, because Europe lacks the scale and growth. The survivor is fragmentation. A world where no single currency dominates, where trade is messier, more expensive, and more volatile, where holding any single currency is a risk. This is what the next 5 years will bring. Not because I say so, because the infrastructure is being built right now, the trade agreements are being signed, the reserves are being shifted, And by the time the average person notices, the transition will be complete. If you see this pattern, if you understand what's happening, you have a choice. Position yourself for the transition, diversify, hold real assets, watch the indicators, or ignore it. Assume the dollar will always dominate. Assume American exceptionalism trumps mathematics. And discover in 2030 that the world moved on without asking permission. The three-currency war is real. The timeline is clear. The outcome is nearly certain. The only question is whether you'll be prepared for what comes next, or whether you'll be the liquidity that gets transferred to those who were. This is how currencies die. Not with explosions, with math. Slow, then fast. Ignored, then undeniable. Subscribe if you want to track this war as it unfolds. Because by 2030, everything you thought you knew about money will have changed, and the people who see it now will be the ones who survive what's coming.